Assalamualaikum to Sir Mustafa Kamal and welcome to our video presentation. This video is our group presentation in preparing the assigned case study on topic of financial ratio analysis. We have chosen the SIMW group for our task. We begin by explaining what the beneficial of financial ratio analysis to the firm. A viable business and mission require effective planning and financial management. Ratio analysis is a handy management tool that will improve the understanding of financial results and trends over time and provide key indicators of organizational performance. Managers will use ratio analysis to identify strengths and weaknesses from which strategies and resources can be formed. Funders may use ratio analysis to evaluate the outcome against other organizations or make judgment regarding management effectiveness and mission impact. As shown on the slide, there are few essential elements for ratio to be beneficial and purposeful. First, the ratios are calculated using definitive and accurate financial information. Second, the ratio needs to calculate consistently from period to period. The ratios are used in comparison to internal benchmark and goals. They are also used in comparison to other companies in the industry. The ratios are viewed both at a single point in time as an indication of broad trend and issues over time. And lastly, the ratios are carefully interpreted in the proper context, considering there are many other important factors and indicators involved in assessing performance. For this case study, we will be present the four major categories of financial ratio, and they are liquidity ratio, asset management ratios, leverage ratios, and profitability ratios. The objective of the assigned case study will examine the financial statement and analyze its financial prospect in terms of liquidity, the efficiency of the asset to generate sale, capital structure, and the efficiency company to generate a profit for SIMW Group. The main data source is the published annual report of SIMW Group for the year ended 2016, 2017, 2018, 2019, and 2020. This report will concentrate on SIMW Group performance as a group, which includes SIMW Industrial, Ramsay SIMW Healthcare, SIMW Motors, and SIMW Logistics. The report shall exclude discontinued operations SIMW Plantation and SIMW Property.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Afiq. I am going to summarize about liquidity ratios. Liquidity ratios are an important class of financial metrics used to determine a debtor's ability to pay off current debt obligations without raising external capital. Liquidity ratios measure a company's ability to pay debt obligations and its margins of safety through the calculation of metrics, including the current ratio, quick ratio, and operating cash flow. With liquidity ratios, current liabilities are most often analyzed in relation to liquid assets to evaluate the ability to cover short-term debts and obligations in case of an emergency. Liquidity ratios are divided by three. First one is current ratio. The current ratio measures a company's ability to pay off its current liabilities, which is payable within 1 year, with its total current assets such as cash, account receivable, and inventories. The higher the ratio, the better the company's liquidity position. Current ratio are equals to current assets divided by current liabilities. As you can see in the table, it shows that SIMW's current ratio decreased about 10.98% in 2018 and increased in 2019 and hit the worst in 2020. In 2017, they decreased about 2,676,000,000 in their receivables from 2016. In 2019, they decreased their inventories and they got a slightly higher ratio compared to 2018, decreasing in their current assets and increasing in their liabilities make their ratios go lower in 2020. Next is quick ratio. Quick analysis is used to examine the ability of a business to pay its bills. In essence, any quick ratio of 2:1 or better shows that a company is likely able to pay out its short-term obligations. The quick ratio is based on those assets and liabilities on a company's balance sheet that are most liquid, which usually results in the following formula. Quick ratio is equals to current assets minus inventory minus prepaid and divided by current liabilities. It shows that the ratio was higher in liquidity in 2016. It indicates higher ability to meet short-term obligations as they come due. A downtrend analysis was seen since 2016 and can be concluded the Sandabi group likely struggled with paying debts. This is a bad sign for investors and partners. Therefore, the Sandabi group has added volume to the sales since 2016 and hit the highest in 2020. And the fluctuating margin in ITO showed that the Sandabi group took into consideration to increase the quick ratio margin. In order to improve on the quick ratio margin, the Sandabi group has improved the collection period down to 39 days in 2020. Net working capital is a liquidity calculation that measures a company's ability to pay off its current liabilities with current assets. This measurement is important to management, vendors, and general creditors because it shows the firm's short-term liquidity as well as management ability to use its assets efficiently. The net working capital formula focuses on current liabilities like trade debts, account payable, vendor notes that must be repaid in the current year. It only makes sense that the vendors and the creditors would like to see how much current assets that are expected to be converted into cash in the current year, are available to pay off for the liabilities that will become due in the coming 12 months. If a company can't meet its current obligation with current assets, it will be forced to use its long-term assets or income-producing assets to pay off its current obligation. This can lead to decreased operation sales and may even be an indicator to severe organizational and financial problems. Net working capital equals to current assets minus current liabilities. As you can see in the table, net working capital for Sandabi was positive for 5 years in a row, even though they had the biggest decrease in 2017, but still a positive NWC. The highest NWC margin in 2016 resulted from the Sandabi group having too much inventory and not enough investing its excess cash. NWC margin declined in 2017 and 2018 by 47.59% and 14.43%. It appears that the firm is better positioned to take advantage of new business opportunities. The Sandabi Group has available suppliers support and the additional funds also which are a prerequisite to encash the new opportunity.
Assalamualaikum warahmatullahi wabarakatuh. Mustafa Kamal. My name is Muhammad Hafizi bin Azmi, and I will continue the group's presentation on Sandabi's ratio analysis. I will cover the area of asset management ratio, where we will be looking at the total asset turnover K2, fixed asset turnover K2, inventory turnover K2, and average collection period ACP. Now, asset management ratios are used to consider how effective a firm is in utilizing its assets to generate sales. We will be using the firm's statements of profit or loss, as well as the statements of financial position. The ratios are also referred to as turnover ratio, as it reflects the number of times a particular asset account balance turns over during the year. So let us proceed with the first ratio. Now the first ratio is the total asset turnover. Here you will be able to see the amount of sales generated per ringgit investment in the firm's assets. So in other words, it just measures how well the firm is in managing its own assets. What we'll be looking at now is Samdabi has managed its assets more efficiently in the year 2018 up until 2020 as compared to 2016 and 2017, where in 2016 and 2017 the average Tato is 0.46. The reason why we can say that Samdabi has managed its assets better in the past 3 years is because they have a higher revenue generated and lower total assets, ranging and averaging around 25,000 here, compared to 2017 and 2016, where the revenue was lower compared to the past 3 years. However, they had a very high asset of 67, around 66,000 average year. And the reason why we can say they had a higher total assets in 2017 and 2016 is because Samdabi, they were still engaged in their plantation and the property business, whereas from 2018 onwards they had moved out from those two sectors. I want to highlight the difference between 2020 and 2019, where there is a slight reduction of 4% in total assets by year end as compared to 2019. And this is due to the increase in non-current assets for Samdabi, such as the property, plant and equipment. Now we're moving on to the next one, which is the fixed assets. We can see that the Samdabi has gradually had a very good increase of FETO from the year 2016 year on year up until 2020. This is mainly due because Samdabi has managed to have a very high income and also lower its fixed assets throughout the years. That means they have managed their assets, fixed assets, much more better. Now we're looking at the inventory turnover. So we can say that in 2020, Samdabi has managed its inventory turnover better compared to 2019 by 5% between these 2 years. The reason is because in between the difference of 2019 and 2020, the group's industrial division, namely in Australia and Pacific Island, have made a conscious effort to reduce the holding inventory aging more than 180 days. Yeah, between these two here. So that's why they have a much more better inventory turnover compared to, if I were to compare it to the year 2016. 2016, we can see that the ITO is 3.08. It is the lowest compared within these 5 years. And the reason is because it had a very low cost of goods sold, but very high inventory of 9,412. So that is much more higher if we compare it to the other 4 years. And lastly, we're looking at the average ACP. So for the ACP, it averages around 51 days in the past 5 years. We can see that in 2020, it had the best ACP of 39 days. And this is due to Samdabi having generated high revenue and also having one of the lowest, I would say, account receivable. So they have managed to collect their payments much more faster within the past 5 years here to achieve that 39 days. Okay, so this concludes my portion of the presentation. Thank you very much and Assalamualaikum.
I am Muhammad Amir bin Zainal, student from UiTM Bachelor of Business Administration. Will be sharing with you all on leverage ratios. So leverage ratios are used to determine the relative level of debt load that a business has incurred. These ratios compare the total debt obligation to either the assets or equity of a business. A high ratio indicates that a business may have incurred a high level of debt that it can be reasonably accepted to service with ongoing cash flows. The four main leverage ratios are debt ratio, time interest earned, debt equity ratio, and equity ratio. So let's first go through the debt ratio. The debt ratio is a financial ratio that measures the extent of a company's leverage. It is defined as the ratio of total debt to total assets. Expressed as a decimal or percentage, it can be interpreted as the proportion of a company's assets that are financed by debt. As mentioned, the importance of debt ratio is key for a company to measure the amount of leverage to balance in terms of total debts to total assets. Also, it varies widely across industries, with capital-intensive business such as utilities and pipeline having much higher debt ratios than other industries such as the technology or services sector. Debt ratio can be computed by using the formula of total debt divided by total assets, which results to the debt ratio. So from what we can see in the report of the NBI2B group from the year of 2020 to 2016, in the year of 2016, they reported with 0.44 debt ratio. And in the year of 2017, they decreased a little bit to 0.401. And following 2008, going up a little bit on 0.407, and 2019 increasing by 0.01%, 0.01 pointers. And in 2020 remarks their second highest debt ratio, which is 0.427. So based on the data recorded above, the company debt ratio clearly shows adequate and balanced results with slight fluctuating trends, as we can see in the past 5 years. Annual report with the highest ratio in 2016 and the lowest are in 2017. 2016 was the highest total debt with 28,919 million for the past 5 years that we've recorded. So a ratio greater than 1 shows that a considerable portion of debt is funded by assets in a company. In other words, the company has more liabilities than assets, and a high ratio also indicates that a company may be putting itself at risk of default on its loan if interest rates were to rise suddenly. A ratio below 1 translates that the fact that a greater portion of a company assets is funded by equity. Hence, to conclude that throughout the 5 years, NBI2B has been performing well in terms of ensuring their debt ratio balance with their total amount of equity. So next, let us go to the time interest earned throughout the years of 2020 to the 2016. So what is time interest earned? Time interest earned ratio is a measure of a company's ability to meet its debt obligations based on its current income. The formula for a company TIE number is earning before interest and taxes, EBIT, divided by the total of interest payable on bonds and other debts. Therefore, the importance of TIE for an organization is to identify and indicate the ability to pay its debt. With better TIE record showing the stability of an organization after paying its debt. So it can be computed by EBIT, earning before tax, divided by interest. So throughout the year of 2020 to 2016, we can see that 18.91, which was recorded in the year of 2020, the highest best performance, shows a staggering increase in TI throughout the 5 years and indicates 9% increase from the year of 2016. This is due to 2020 remarks the highest earning before interest amount compared to the other 4 years, which result in the highest TIE. Time interest earned ratio also measures a company's ability to continue to service its debt. It is an indicator to tell if a company is running into financial trouble. A high ratio means that a company is able to meet its interest obligation because earnings are significantly greater than annual interest obligation. However, a high ratio can also mean that a company has an undesirably low level of leverage or pay down too much debt with earnings that could be used for other investment opportunities to get higher rate of return. And next, let us go to debt to equity ratio. So what is debt to equity ratio? It is used to evaluate a company financial leverage and is calculated by dividing a company total liabilities by its shareholder equity. So debt equity ratio can be computed by total debt divided by equity. So from the year of 2020 to 2016, you can see on the screen that we have reported that the highest debt to equity ratio was recorded in the year of 2016. This is due to high amount of liabilities and equity, which result in high risk of the company's shareholder. However, slight incline throughout the next year is recorded, which shows necessary attention taken to the remarks recorded in 2016. The debt to equity ratio compares the amount of a firm debt to the value of its net assets. It's commonly used to determine how much debt a firm is taking on to leverage its assets. A high debt equity ratio is frequently associated with high risk, indicates that a corporation that uses debt to fund its expansion. Hence, SIMW Group has taken matters to consideration based on the high debt to equity ratio to enjoy the shareholders' trust. The data for 2020 indicates the second highest debt to equity ratio. However, based on the company performance, SIMW will need to take necessary action as per years articulated before. Now, lastly, let us go into the equity ratio, which was recorded from 2020, 2019, 2018, 2017, 2016. But first, let us know what this equity ratio is. Equity ratio is a financial metric that measures the amount of leverage used by a company. It uses investment in assets and the amount of equity to determine how well a company manages its debt and funds its assets requirement. If a high amount of debt is used to finance growth, a company could potentially generate more earnings that it will have without debt financing. If leverage increases earnings by a greater amount of the debt cost, which is interest, then shareholders should expect to benefit. However, if the cost of debt financing outweighs the increased income generated, share values may decline. So equity ratio can be computed by total equity divided by total assets. So based on the 5 years on the data recorded above, SIMW recorded on the equity ratio shows that it has demonstrated frequent remarks from 0.55 to 0.6 throughout the 5 years. Hence, this clearly shows that the group is a less leveraged company due to its data often exceeding the 0.5 landmark for a high leverage company. Any company with an equity ratio value that is 0.5 or below is considered a leveraged company. The higher the value, the less leveraged the company is. Conversely, a company with an equity ratio value that is 0.5 or above is considered a conservative company because they access more funding from shareholder equity than they do from debt. A high ratio value also shows that a company is all around stronger financially and enjoys a greater long-term position of solvency than companies with lower ratios. So that's all from me on leverage ratios. So we'll go on to the next section. Thank you very much.
Assalamualaikum, and my name is Nurhati Musa. I will be presenting insight of profitability ratio for SIMW from year 2016 until 2020. Every firm is utmost apprehensive with its profitability. One of the utmost commonly used tool of financial ratio analysis is profitability ratio, which are used to ascertain the firm's bottom line. Profitability measures are imperative to firm managers and owners alike. Net profit margin assists the investors assess if a firm's management is initiate adequate profit from its sales and whether operating costs and overhead costs are being curbed. The first ratio is the operating profit margin. An operating profit margin measures how efficiently a firm is able to generate profit through its gross operation prior to subtracting taxes and interest charges. From this table and the graph, we can see the decline in OPM from 3.1% in 2016 to 2.4% in 2017 appears to be the result of SIMW Group's operating leverage. However, the OPM seems to cautiously increase from 2017 to 2019. The group showed they are better at inventory management for those 3 years in the They have slightly declined in OPM than NBI2B for the year 2020 by 4.6% and 1.88%, but the revenue in 2020 is the highest since 2016. The growth of OPM indicates that the firm is earning enough money from business operation to pay for all the associate costs involved in maintaining the business. Next, we have the net profit margin. When doing a straightforward profitability ratio analysis, net profit margin is one of the most prime indicators of the firm's overall financial health. The net profit margin shows how much of each sale ringgit shows up as net income after all expenses are paid. For example, if the net profit margin is 5%, that means that 5 cents of every ringgit is profit. The net profit margin computes profitability after consideration of all expenses including taxes, interest, and depreciation. From this table and the graph, we can see the net profit margin decline substantially in 2017 and 2018, then improved in 2019 but not reaching 2016 levels. However, the net profit margin had declined in 2020 by 15.71% despite having the highest collection of revenue since 2016. The ratios indicate the firm's ability to fulfill the firm's goal to optimize the group's treasury and to allure new capital is higher. The growth of net profit margin showed the firm was able to effectively control its costs and provide goods or services at a price significantly higher than its cost. Meanwhile, return on asset is a profitability ratio that provides how much profit the firm is able to generate from its asset. It measures how efficient the firm's management is in generating earnings from their economic resources or asset on their balance sheet. The return on asset ratio is related to the asset management category of financial ratio. SIMW Group seems to hit the highest ROA margin in 2016 and lessened in 2017 by 4.5% and the lowest in 2019 by 30.73%. SIMW Group seems to be facing major strategic management by expanding too quickly. It has purchased over 3,171 million assets in 2017 than in 2016. The capital expenditure have rapidly increased. The falling margin in 2018 due to over-invested in assets that have failed to produce revenue growth which can lead them to trouble. Therefore, SIMW Group has taken into consideration to increase the net income in and improve efficiency on current asset and fixed asset in 2019 and 2020, which resulting in the ROA margin climbing 44% in 2019 and slightly falling again by 19.9% in 2020. The gross profit margin is frequently expressed as a percentage of sales. It reveals the percentage of each ringgit left over after the business has paid for inputs. This ratio looks at how well the firms govern the cost of its inventory and the assembling of its product and eventually passes on the cost to its customers. The gross profit margin expresses the amount of profit made before deducting selling, general, and administrative costs. The higher the gross profit margin, the better for the group. We can see from the table and the graph that the gross margin in 2017 until 2019 as a result of some combination of reasonable profit on sale and overhead cost control SIMW. However, gross margin slightly declined in 2020 by 2.94% despite total revenue reaching the peak in the same year. Apparently, SIMW Group was having difficulties dealing with suppliers raising the cost, which resulted in decreasing the margin in 2017 by 6.17%. Hence, SIMW intends to grow the sale from 2018 onwards and reach the highest in 2020. The growth of GPN allowed the firm in better use of cash flow to expand the production. They can spend additional amount on marketing to extend sales. They can build new production facilities or invest in equipment to assist increased production. A high gross profit margin gives the firm the liquidity and flexibility to innovate, enter new market and aggressively. Lastly, we have return on equity ratio. The return on equity ratio is perhaps the most significant of all the financial ratio to investor in the firm. It measures the profitability of the firm in reference to stockholders' equity. This is the ratio potential investors scrutinize when deciding whether or not to invest in the company. Whether an ROE is considered satisfactory will depend on what is average for the industry. SIMW enjoyed the highest ROE margin in 2019 among 5 years. The margin showed the decline in 2017 and climbed by 132% in 2018 and continued to grow at 44% in 2019. Investors appear to start to invest more in 2019 after a huge draw of 25,787 millions in 2018. The table shows trend analysis in 2017, and this is enough to convince the investors to fund into the firm after the SIMW is seen as efficient at asset management, leverage, and pricing.